Good morning, good afternoon, good evening, folks. Michael Zuber, one rental at a time. And as mentioned in the daily financial news, we are extremely lucky and fortunate to have the one and only Jonathan Twomley every Thursday. How you doing, sir?
I'm doing well, thank you. I'm sorry, there is a broker calling me right now about a deal I'm working on, but I'm gonna have to put him on mute. So
that's right, because we talk first, deals come second.
That's right. So
that is
I'll
awesome.
call him back later. I'm glad to be back. I know I missed last week, so
Yeah.
It's good to be back again, and looking forward to today's discussion. Which
Absolutely.
A lively one.
Yeah, so this first one's important to me. Again, you are a call it Harvard educated attorney. Is that the right lingo?
No. Technically, I was not. I was educated at Harvard, but I did my law degree at Columbia. So
okay, so very educated, Harvard undergrad, Columbia law degree. Yeah. The reason that is important to me is because I want you to kind of poke at what I'm going to lay out for the U.S. economy in 22, 23. Okay. Attorneys that I know, like yourself, you have ability to analyze things like few folks. So we're going to talk about 2022, 2023, 4 economic variables: inflation, unemployment, the Fed, and GDP. I will let you pick which one we start with.
Well, I mean, let's start with the one that's on everybody's mind: inflation.
Yeah, so inflation. I believe inflation, again, PCE just got reported this morning. I think it was 6.4. I wrote it down, but I don't have it in front of me. 6.4. So record high since 1982, right? I think April of 1982. Inflation is a problem. I believe when I did my 2022, 2023 review, I used CPI because it's the one most people look at. CPI last reading was 7.9. I believe inflation gets worse before it gets better. I believe over the next 3 to 6 months, inflation will peak in double digits. Then because of how CPI is calculated and this thing called base effects and all of those things, inflation will appear to roll over, meaning it will stop going up. It will end 2022 north of 5%, and then likely end 2023 north of 3.5%. So inflation will be above trend. Again, if you call trend 2.5 or 2% for the next 18 months, that's kind of how I see inflation playing out. Basically, the worst isn't over; it's close. Then we have some mathematical base effect nonsense, which most people don't understand. We'll make it appear to roll over, but it will be a problem all year and continue to be a problem next year.
Yeah, I mean, I can't really pick anything out, pick anything wrong with that. Like I don't really see anything other than the Fed acting very aggressively, which may happen. We can talk about that.
That's one of the variables. Yep.
I don't really see anything changing in the short term anyway, as long as you have the economy just ripping along the way it is, and you've got, this is like another mathematical thing going on, which is that we had a big recession we're coming out of too. So if we talk about base effects, there's that too. I mean, we had a lot of, depressed economic activity the last couple of years. So, so I don't really see it. I think it's going to be just the way that you described.
Okay.
Like it's going to continue to go up for a while.
Yep.
It'll sort of play itself out, and between, aggressive Fed action and the supply chain issues getting themselves sort of worked out and stuff like that, you'll see, I think, the slackening off of inflation. So I think it will continue to be a political issue because it's a really low-hanging fruit.
It will impact the November elections.
Yeah, I mean, whoever's in office will get, when inflation is happening, will get bashed with that, regardless of what the cause of it is. It's just too easy to, avoid it. So it's sort of political malpractice not to use it.
Exactly.
But I mean, I don't really see anything that would disrupt your analysis. Although I would like to, I don't think this is on the agenda for the 4 topics, but I think it fits in here. I mean,
sure.
The Fed, we and I had discussed it a couple of weeks ago when I couldn't make a call last week because of a family issue, but about Goldman Sachs predicting
Mhm.
2 very aggressive rate hikes by the Fed later
Yeah.
this of 0.5 point each.
Yep. So
Would be,
that is one of the 4 things we're going to talk about. So we'll go there now. The
we'll
Fed.
yeah, you want to shift to
Yeah.
that topic? Yeah.
Sure. So the Fed. So like Goldman Sachs, actually, it's really cool because if you go back to my daily financial news, I think it was 2 days before that article came out, I called for that. So I called for what the Fed wanted, which was 2 50 basis point raises back to back. I think it's May 3rd and 4th, and then June 15th and 16th.
I mean, you were in our last discussion, you were talking about your disappointment at the Fed for for only going up a quarter point, not being more aggressive. But it seems like Goldman Sachs is listening to our podcast.
Yeah, exactly.
They do. The Fed is probably listening to. I'm sure Jerome Powell has got this saved on his phone.
Yeah, of course.
Say about it. But yeah, it seems like Goldman is kind of thinking the same way that you are on this issue, and I think that that will put as we've discussed before. I mean, the Fed is in a tight spot. They've left loose monetary policy in place for too long. It's led to a lot of the inflation that we see right now. Now they've got to jam on the brakes, and they're just hoping with their fingers crossed that by jamming on the brakes, the economy is so strong that they can jam on the brakes of easy money without tipping the economy into recession. And that's, that remains to be seen whether they can pull that off. There are some economists that I've seen who are saying, don't worry, the economy is so strong, it doesn't matter. And others that I've seen who are saying, hey, the Fed shouldn't be doing anything. They should just be letting inflation run because that's much better than having a recession.
Yeah.
So,
So my thoughts for the Fed is they're going to be more, and I just to kind of pivot back about 2 days after Goldman's article came out. Don't know if you saw it, but Citigroup came out with something that's even more aggressive than I want to be. Citigroup said 4 50 basis point raises in the next 4 meetings.
Wow.
That was even too much for me. I'm like, whoa, that would run the car into the wall. So I don't think that coming, but I see 2 for sure. So where I see the Fed going is the Fed will be aggressive up front. They should have been before, but can't undo what's done. They will be aggressive in the next 2 meetings, and then they will probably take a pause and then raise a couple of quarter points. Basically, I believe ending the year with the Fed funds rate at 2.5 or 2 3/4. Then I believe they're not done. I do believe that the Fed funds rate may have to get to 3.5 to 4%. I believe the Fed must, big capital letters, underscore, italics, whatever you want to call it, must end 2023 neutral. The Fed funds rate must equal or be slightly above what they call PCE or inflation. So that has to happen. And I don't think they get there until the end of 2023.
Yeah.
That's number 2.
I mean, I don't really disagree with this either. I also, think it's worth remembering that here we are talking about Fed funds rate of 3 as if it's some kind of unprecedented disaster, whereas for most of our lives, in most of history, it's been over 3, right? And it's only and it's sort of like, we've gotten so addicted to cheap money that this seems like a horror story. And I guess, it is in a way, if you have based all your assumptions on there being super cheap money forever. And there are lots of people, frankly, who believe that, they look at that chart of the Fed funds rate over time and it's basically going in one direction. Right?
Yeah. Well, now it's flat, right? It's got a couple ups and it's just flat. Right. Yeah. There are people that are betting huge gobs of money that ain't going to go anywhere. I think they're wrong, but we'll see.
Yeah. Those people were saying essentially it's been going down for 40 years. So therefore it must continue to go down. Right. Which doesn't, arguments based on the linear direction of a chart don't.
They said housing was supposed to go up forever. Also, I remember how that turned out.
The long-term trend is that it did, right? But but that doesn't mean that it will all the time. And if the Fed has been saying for 10 years now that it wants to normalize rates, right? You have to imagine that, they mean what they say. And if they're
Mhm.
trying to do it now, uh, then it's going to happen. So,
Yeah.
especially with this inflationary pressure. I mean, one thing we haven't really talked about is we haven't gotten conspiratorial yet, and
No.
we haven't discussed the possibility of whether the Fed actually sees the opportunity now to
Mhm.
get back to the normalized rates that they've been saying for 10 years they want to get to, right?
Okay.
And inflation gives them the cover
Oh, yeah.
to do it, which, I mean, my view. I think interest rates should be higher. I think that
Oh, no question.
rates are bad, even though there's going to be pain from causing interest rates to rise. I think in the long run,
Mhm.
it's better for everyone that we have higher
Totally
interest
agree.
rates.
I think it has. I think it has to happen. The only thing that cheap money or zero cost of debt is bad decisions.
Yeah,
If the money costs you zero, you could be a moron and make 3%.
it leads to bad decision making, right? It
Yeah,
leads to malinvestment, and
absolutely.
it leads to things like, as we've talked about before, companies borrowing money cheaply to buy back shares and
Mhm.
just juice stock prices rather than invest in anything, right? So
Mhm.
um, it's having the risk-free rate of return be so low
Mhm.
leads to bad decision making. So we need to have it higher, but it's going to be painful. But I think,
Yep.
I do think the Fed, even though they're publicly talking about inflation as a problem,
Mhm.
and this is why they have to raise rates, I think another way of looking at this may be that they're looking at it and saying, oh, we finally have cover
Yeah.
to raise rates, and potentially maybe we have the opportunity to do it without damaging the economy, because the economy is so hot right
Yeah.
now.
Well, we'll get into that one next. So we got two more left. We got unemployment and GDP. Let's go to unemployment first. So last reading of unemployment that I saw or I remember was 3.8%. I actually think between now and kind of the end of summer, unemployment actually goes down
Further.
further. I think it could bottom around 3.2, 3.1 to 3.3. So I'll split the difference, call it 3.2. In the end, I think the service sector takes off. I think the summer travel season, I think there's we've got enough stuff. We need to do more things. I think, and that leads to wage inflation and all those things we talked about, up in variable one. I think unemployment goes down. I do think it bottoms this year, probably August, September. And then unfortunately, I think it goes up from there. I think it ends the year probably still below 4% because I don't think it really takes off. But by the end of 2023, I believe we have 6.5, 6.8% unemployment. Um, as you will see on our final variable GDP, I think we are in stagflation. I define it as high inflation and low growth. I think that is clearly what 2022 will be. I think at some point we exit that, and we don't exit that, as I've already said, because inflation is down. We exit it because GDP actually goes negative. I believe we have a recession next year. I think it could be deep and dark and long, but I'm not calling for that now. I'm just saying we have a recession in the second half of 2023. So I think unemployment goes down. I think it bottoms this year. I think it ends this year okay, right? 4%. But I think it goes up from there to like 6.5 by the end of next year.
So well, let me ask you this. What's
Sure.
the basis on which you think there's going to be a recession? Is this a Fed induced recession because of rising interest rates, or what's the?
I think there's two things. I think that's the easy answer, right? Demand destruction, which I actually think will be the least consequential. I think what's really going to happen is I don't think the average American is strong as the stats tell us, the 1.3 trillion, the 11 million jobs and, whatever it is. I don't think the economy is nearly as strong. I think the average American is worse off today than before. We've already talked about inflation being a problem for the next 18 months. That is going to force people to make hard decisions. Cost of capital is going to go up. Businesses are going to go out. We've already seen a down round in tech. Instacart was valued at 39 billion when money was free. Money's not free. Now they had a down round to 24. I think that's just the start. I think businesses are going to go out. I think retailers are going to go out. The economy is not strong, in my opinion. The only reason it's strong because of free money. Refis are down 60%. That's a lot of cash out, a lot of rate and term. It's just, we are going to pay for the sins. I think the hangover was coming. I think the pandemic, and there's just so much. We rained money down on folks. And if we didn't rain money down on you, we lowered your expenses, which was the same effect. And now it's time to pay. And yeah, I don't have a great feeling.
So here's where I'm going to poke
Good.
a hole in your argument. So we've kind of been
perfect
now, but so what is going on in the labor market is very interesting.
Mhm.
And that is that people are changing jobs. They were not able to change jobs for a couple of years.
Yeah,
right?
The Great Resignation. Yep.
Because so the Great Resignation, I know there's a lot of people who have been bellyaching about this and saying nobody wants to work. And I'll get into this. This is also very interesting. So where this is coming from.
Mhm.
But what has happened though is that people are there's 2 years of pent up job changing that didn't happen. That's all
True.
happening now.
True.
And so what people are doing is they're moving up into better jobs that have better pay.
Yep.
So
Totally
they
agree.
have more money in their pockets, and you're not seeing wage inflation because the way that they measure it is not based on like me getting more money. It's the
Right.
job getting more money.
Correct.
Right. And the jobs are not getting more money necessarily. And maybe to some extent they are, but it's mostly people going from like, you know, a $17 an hour job to
Yep.
a $20 an hour job, but the job is still paying 20, right? And there's,
Mhm. Mhm.
so you're seeing that. So that means too that, well, yeah, there's inflation, but people are making more money. And they're
True.
complaining a lot about stuff like, because they see it when they go to the gas station, right? Gas is really expensive. There's a lot, and for some reason, gas is the thing people always bellyache. And I think probably they bellyache about it because it's very easy to see.
Yeah, the little number right there. Yeah.
Yeah, it's like it's probably just about the only price of anything that you are really paying attention, because you're not really noticing the
Yeah.
price.
Most people fill up their tank.
Right.
Most,
Like once a week or whatever,
Yeah,
right? So
whatever,
they're
yeah.
seeing, right?
Mhm.
So I think, but they're not at the same time. So they're saying, damn it, I'm paying $6 for gas, and you know, it used to be 3.
Yeah.
But but at the same time, they're not looking at like, well, I'm also making a whole lot more money than I was last
Okay.
year, right?
Sure.
So I think that's one thing that's going on with the economy that, to my mind,
Okay.
I'm actually less worried about inflation, because I still continue to think that it is going to play itself out,
Okay.
right? The way that you suggested. I do think the Fed is more of a potential problem
Mm.
in like shutting off the supply of free money. However, even there, I like, so I don't have a crystal ball, and I don't have like a very strong view because I'm not an economist.
Mhm.
But I do think that like Wall Street is not Main Street, right? So
for sure,
if
yeah.
Instacart gets a lower valuation because now people don't, the investors don't have free money to throw at it,
Mhm.
it doesn't really actually have any impact on like how many people are using Instacart, right? So it's just the multiple that Wall Street is willing to pay for that stock that's affected, but it doesn't actually affect the company's profits or anything. It just affects the multiple that they're willing to
Well,
pay.
let's not forget, and the reason it's a problem is because I lived through the .com crash where we had down rounds before. There are hundreds, if not thousands, of employees there that had options or shares at a higher strike that now are upset. And, you know, again, down rounds can lead to layoffs because you got to watch your burn rate. And, you know, this could be another, you know, .com kind of adjustment in the valley where we just have less engineers and computer scientists and all of that stuff. That could be an outcome.
Yeah, well, I guess it just sort of then really matters like how widespread this is,
Mhm.
right? And who
Of course.
does it affect, you know, maybe the companies it affects more are the ones that kind of deserve it, like the ones that were
Sure. The zombies. Yeah. Mhm.
So then the
Yeah.
other thing I wanted to point out about the Great Recession,
Sure.
very, very interesting, and I wish I had saved this this chart because it came up on Twitter. So the other day when I was just looking at, you know, sort of scrolling,
Mhm.
so the people that are being hurt the most by the Great Recession are small companies, right?
Yes.
So
they're losing.
because they are the ones who, their employees are the ones who are leaving to go to better jobs elsewhere.
Yeah,
right?
I think I saw that chart. Yep.
Yeah, and so big companies and you know, it's sort of like the bigger you are, the easier it is for you to hire. Like they're
Yeah.
fine.
The
Like,
strong gets stronger. Yep.
yeah, they're just like sucking up all these new employees and paying them what they ask for, and like everything's hunky dory. And then medium-sized companies are still doing reasonably well, but the ones that are really getting hurt are the small businesses where, if they pay somebody a little more money comes out of their pocket, right?
Yeah.
So they are really feeling it, and they're the ones who are saying nobody wants to work. Well, it's not that nobody wants to work, it's just that nobody wants to work for you paying what you're offering because they have better options now and they haven't for quite some time, right? So again, like when, I found that really, really interesting actually seeing that chart, because it just reinforces this idea that like all these people are kind of leveling up at the same time because the economy has opened up, and you haven't had like you will see it though when you talk about unemployment. This is why I thought of this, because when you talk about unemployment going down to 3%, right? What that means is that people are getting sucked out of off the sidelines because of higher wages, right?
Yeah, absolutely what it means. Yes.
So, and the labor participation rate goes up. So, I mean, you will have people filling those jobs eventually. That's, because they'll raise wages enough that
pulls me off the sideline
in there. And then then they've got to pass on the cost increases, and that leads to inflation. But this is, what I regard as sort of healthy inflation, wage price inflation, as opposed to, just free money inflation. So, which is just economically unproductive. Like this is the kind of inflation, as long as it doesn't get out of control, and we can sort of debate what out of control means. But if you talk about 8% on 8% inflation when you've had coming out of a recession is not the same thing as 8% inflation on top of like an uninterrupted period of economic growth, right? So there's a bit of a just a numbers thing going on, and a bit of a pent up demand thing going on. So I don't, and historically, I mean, inflation of 5% has historically been quite common. We again, along with cheap money that we got addicted to very low inflation, and it's just not historically, just there's a lot of people who just have never experienced anything else, so it seems painful. And obviously, it's a little bit, like far be it for me to say, oh, you should not. So it's painful for you, but suck it up because like, well, this is life. I mean, this is how life used to be. That's. I mean, obviously,
I remember
real pain right now, but this was normal not that long ago, and nobody really complained about it at the time. Maybe because they also went through, like you and I, we went through 20% inflation or whatever. So then 5%
I remember pushing our car to the gas station. I remember that because we didn't want it to idle. So yes, I remember. Yeah. So I guess kind of rounding it out and I see a year of stagflation probably extending into next year sometime, and then a recession. Sounds like you're not up for calling a recession next year. It's kind of.
I mean, look, let's put it this way. I don't feel strongly enough about it to call it, right? If it happens,
it wouldn't surprise
I won't be super surprised, but at the same time, I don't feel like the numbers say this is where it's going to go.
I love it. That's why I asked. That was very cool. Jonathan, where can people find you? Because you put out lots of amazing stuff.
So, well, there's a whole bunch of different ways, but you can join my free Facebook group, which is Multifamily Investment Community. You can come and find my investment website at Two Bridges Asset Management. Just Google it. That's the easiest way to find it, Two Bridges Asset Management LLC. And you can also join my programs if you want to go to multifamilylaunchpad.org/join. You can find all the information there.
Awesome. Thanks, buddy.
Yep.